Welcome to Bloomberg Quinn. An important development that occurred over the weekend as far as the banking system is concerned. The Reserve Bank of India has asked lenders to set aside additional capital, that is, make higher provisioning requirements for all the stressed accounts that are being referred to the bankruptcy court. Specifically, RBI has asked banks to set aside 50% provisions against secured portion of these loans and 100% provision for the unsecured bit. To discuss what this could mean for provisions and earnings for banks, you're being joined by Mr. Krishnan Sitaraman, the Senior Director at CRISIL Ratings. Thank you so much for joining us, Mr. Sitaraman.
Thank you for having me.
My first question, CRISIL report suggests that banks could have to take about 60% haircut on the 12 largest NPAs that have been identified by the Reserve Bank of India. If you could just take us through what this new norm could actually mean for incremental provisioning requirements for banks in FY18.
To set the context, I think the RBI guidance to refer these 12 top NPAs to the Insolvency and Bankruptcy Code is actually a nudge in the right direction to the banks to actually leverage on the benefits that this code can provide in terms of providing early resolutions to the NPA problem and affect a higher level of recovery. One of the reasons for that is the code has been passed last year, and we've hardly seen too many accounts being referred to this particular code. And probably one of the apprehensions that banks had was in terms of taking a loss or a haircut on these loans if they are referred to the IBC, and that is the resolution recommendation there. So once RBI and the government has given this go-ahead that please go to the IBC, get these accounts resolved, it is kind of a guidance from the regulators and the government to ensure that the banks go ahead with the resolution process and ensure that haircuts, if it is based on appropriate norms and guidelines, should not be an issue. Now, coming to this particular specific reference of these 12 accounts. Now, these 12 accounts constitute around 2 lakh crores of exposures of the banking system. Of that, approximately 40% of that is available as provisions to the banking system, that is around 80,000 crores. Our estimation is that the total loss which could emanate from these accounts is around 1,20,000 crores, that is 60% of the exposure. So that would mean that banks have to provide for another 40,000 crores to ensure that they are fully provided on these. And that is what the incremental provisioning would be. Now, if the entire incremental provisioning were to be done this year, the timing is again something which is not very clear as per guidelines as of now. So there is a possibility that the entire 40,000 crores would need to be provided this year, which then would result in an incremental provisioning of 25% vis-a-vis last year for the banking system. Just to give a context, the incremental provision in FY 2017 was 9%. So as against that, provisions would go up by 25% if entire 40,000 crore were to be provided this year. However, if there is a leeway given to the banking system that it could be spaced out over the next 6 to 8 quarters, then the incremental provisioning could be lower this year and banks will be able to manage their profitability better. So that is what we need to wait and watch as to what is the timeline given to the banking system to space out these provisions.
To comment on that point, Mr. Sitaraman, I believe the RBI has allowed the banks to spread the provisions across 3 quarters starting from the next month. So that's the timeline with respect to spreading of these provisions. Of course, these I'm talking about the accounts which have already been referred to insolvency.
Yeah, so that guideline we have read in the media, but it's not as of now been published as a circular by RBI. So I'll be able to comment on it once it's published as a circular. However, if that is indeed the case, that the entire 40,000 crore has to be provided in this particular year, as I mentioned, the provisions would go up by 25 odd %. So just to give you some numbers, as of March 2016, the provisioning level in the Indian banking system was around 2 lakh crores, which moved up to 2.2 lakh crores as of March 2017. And if this entire 40,000 crores were to be provided this year, we estimate the provisioning level to go up to around 2.75 lakh crores. So it will mean an incremental provision of 25%, and that will have an impact on profitability. So that is something we have to wait and watch as to what is exactly the timeline given. It is possible that there could be a review of this based on the impact of on profitability, but we need to wait and watch. But if the provision is needed to be done this year, it would go up by 25%.
Enough. All right. It's a given that FY18, obviously the banks will take a hit, the earnings, of course, on the back of these incremental provisioning requirements. But if you look at the FY19 numbers, what does the picture look like as far as provisioning is concerned? And to add to that, of course, banks will also have to move to the new Ind AS guidelines, which will be implemented from 1st of April 2018. So if you talk about FY19, how do you expect the provisions to move from this year?
Yeah, it depends on whether the provisions are to be made this year or not. So, assuming that the entire 40,000 crore were to be provided for this year, I would tend to believe that the worst of the asset quality problems will be over by March 2018, because we are already seeing the incremental slippages to NPA coming down. So, for instance, if you look at FY16, incremental slippages fresh to fresh NPAs were around 6.4%. That came down to 5.5% in FY17. And in FY18, we believe the incremental slippages would be sub 4%. So the trend of incremental slippages is slowly coming down, but the stock of NPAs is still at high levels. Now, it all depends on how this referral of these 12 NPAs to the Insolvency and Bankruptcy Code actually pans out. If the experience is positive, I think that would enveloping feel good fact on the asset quality issues, because more and more assets would then be referred to the Insolvency and Bankruptcy Court and higher recoveries would be possible. But that is something which will all come out of the results that we see from the reference of these 12 accounts to the IBC, and that we will be able to see in about 6 to 9 months, because that is the time frame under the bankruptcy code for the resolution to take place. So once that is there, we will have a better idea about how things pan out. But ceteris paribus, we believe that the incremental slippages are coming down. So the provisioning requirement will not go up much more than what we have currently. At the same time, capital will still remain a concern, and banks will still have to look for avenues to raise fresh capital, because from March 2019, Basel III norms are coming into the picture as per current timeline set by the regulator, and that would bring with it its own additional capital requirement. So while the provisioning requirement will not go up much beyond what we have today, but banks will have to look for avenues to raise fresh capital.
Right. On a positive front, do you really believe that this upfront provisioning that the RBI is making banks do will probably result in banks being more open to take larger haircuts, which will lead to faster resolution? I mean, does this really help? Is this the move in the right direction?
I think this is, in our assessment, the RBI move to hasten the cleaning up of the bank's balance sheet. If you look at much of the NPAs which are there, these are all legacy assets. So if you look at when the banks would have lent these loans, it would have been, say, 3 or 4 years back or even further back. We don't see incremental NPAs coming from advances which have been made in the last year or so. So incrementally, banks have already buckled up their belts, so as to say, and are being more conscious about credit decisions on an incremental basis. However, the legacy issues are still there. And it is always that if the books are cleaned up at the earliest, it is good. At the same time, one needs to keep in mind the profitability issues also. These are two different issues. From an asset quality point of view, the faster you resolve the problems, the better it is. At the same time, we also have to look at the profitability. If you make accelerated provisions, profitability will take a hit. If the provisions are spaced out, then profitability can be managed.
Mr. Sitaraman, which are the banks that you believe could be most vulnerable to these tighter provisioning norms?
So I wouldn't like to take individual names, but if I look at broad categorizations, I would see many of the public sector banks are banks which are figuring out on the NPA problem. Their NPA levels are high. If you look at the average NPAs of public sector banks, that is closer to around 12% today, as against the banking system average of around 9.5%. As against that, we see the private sector banks are much better off. Their average NPAs is sub 4%, and some of them are looking at 1% and below as well. So the private sector banks clearly have been able to manage the NPA issue better. Public sector banks are figuring out their way, and the norms like the Insolvency and Bankruptcy Code and the RBI guidelines on this matter would be steps to actually help them get out of the problem. And this is not a immediate step. I think there are a series of steps which RBI has and the government have been taken, starting with the promulgation of the bankruptcy code last year. And post that, RBI has come up with a series of regulatory provisions, including a higher provision requirement for vulnerable exposures, greater disclosure if there is a difference in the NPA recognition between what RBI is saying and the banks themselves are saying. And now this specific reference of these 12 accounts to the IBC. So RBI is taking a series of steps to address the issue. And if these are all implemented well, the key is in the implementation. So if these are all implemented well, public sector banks could come out of the situation they find themselves in. Private sector banks, as I said, are in a much healthier position today.
Mr. Sitaraman, but of course the key question here remains, whether PSU banks are even in a position to be able to, make such sort of provisions and be able to absorb losses, especially given that capital raising from the markets looks slightly difficult, especially for some of these state-owned banks right now.
Yes, as I said, that is a challenge which the banks have to look into. So the options here are either government infuses the required capital in the banks which need them. Some of the public sector banks are well capitalized; they may not need the capital, but others may need. At the same time, there is this option of consolidation as well, which is being talked about. So if there are banks which are having surplus capital and they are merged with the banks which are weak on capital, then on the merged basis, the amount of additional capital requirement may not be significant, and the outflow from the government side can be managed. Also, there is this provision of raising additional tier 1 bonds which have tier 1 capital treatment from the market. RBI has over the last year or so relaxed the guidelines on coupon payment on these AT1 bonds, and we have seen banks increasingly raising AT1 bonds. Investor appetite is also there. So these are some of the ways in which banks can address their capital challenge. But yes, that is a challenge that we will have to continuously monitor going forward.
Very much, Mr. Sitaraman, for sharing your thoughts with us. So that's CRISIL ratings telling us that we could see, or the banking system could see as much as 25% increase in the provisioning requirements for FY18 on the back of these RBI's new norms. Not surprising to see the way in which PSU banks are really reacting today, all of them under significant pressure. That's all from us on banks. Thank you for watching.